When you look at the stock market, there are some patterns that are just, well, they're too consistent to be random. Today, we're going to unpack a really brilliant theory that explains why the market often feels like a two-act play, complete with a super dramatic twist at the end.
Okay, so let's jump right in with the big question. It's a mystery that has kind of stumped economists for decades. We've all seen it. A stock that's on a hot streak just keeps climbing and climbing for a while. But then, almost like clockwork, these big winners eventually hit a wall and start to underperform. So what on earth is going on?
It really is like the market has a split personality. On one hand, you've got short-term momentum. Winners tend to keep on winning. But then you zoom out, and over the long haul, say 3 to 5 years, those same winners often reverse course and fall behind. How can both of these things be true at the same time?
And what makes this so fascinating is that the classic financial models, the ones that are built on the idea that every investor is a perfectly rational supercomputer, they just can't make sense of this. I mean, in a perfectly logical world, predictable patterns like this just shouldn't exist. It's a major crack in the foundation of traditional finance.
So, to solve this puzzle, a couple of economists, Harrison Hong and Jeremy Stein, came up with this really elegant idea. They said, what if the answer isn't about finding a single flaw in one type of investor? What if it's all about the interaction between two different kinds of traders? All right, let's meet our cast of characters. First up, we have the news watchers. Think of them as the old school detectives. They're digging into company fundamentals, reading reports, all that stuff. But they have a huge blind spot. They totally ignore what the stock price itself is telling them. Then you've got the momentum traders. These guys are the trend surfers. All they care about is which way the price is headed. Their big weakness? Their strategies are pretty simple. They can't tell if a price is going up because of amazing news or just because a bunch of other momentum guys are piling in. So, how did these two groups create the patterns we actually see in the market? Well, Act 1 of our play doesn't start with a bang. It starts with a whisper, a single piece of good news that starts to spread, very slowly. This slide just nails the cause of momentum. So imagine some good news about a company comes out. In period 1, only a handful of our news watchers find out about it. They buy, and the price, well, it ticks up just a little bit. Then, in the next period, the news spreads to more of them. They buy. The price drifts up a little more. What you get is this slow, gradual, predictable rise. The market is basically underreacting to the news. And that's the absolute key. It's this initial underreaction, this slow diffusion of news among the detective-like news watchers that creates the momentum we see. It perfectly sets the stage for Act 2. Now, a slow, predictable price drift is like blood in the water for a shark. It's a huge profit opportunity. And this, of course, is where our second group, the momentum traders, come crashing onto the scene. But here's the real million-dollar question. If the momentum traders are just trying to cash in on this slow price drift, why don't they just fix it? Make the market efficient. How does their attempt to solve the problem of underreaction actually end up making things so much worse, creating a gigantic overreaction? Right. Well, here's their fatal flaw. A momentum trader sees a price rising and they jump in. They assume it's because of some good news that the market hasn't fully appreciated yet. But here's the kicker. They have no way of telling the difference between a price move that's driven by real fundamental news and one that's just driven by other momentum traders doing the exact same thing. And this creates what economists call a negative externality. It's like a chain reaction. The first wave of momentum buyers pushes the price up. The next wave sees that price rise and gets a serious case of FOMO. They think, wow, there must be more good news. So they buy, pushing it even higher. This feedback loop just keeps going, with each group of buyers tricking the next, and the price gets pushed further and further away from its actual value. Okay, so now let's put it all together. This is where we see that underreaction and overreaction aren't two separate puzzles at all. They're actually two sides of the very same coin. So let's picture a world with only our news watchers. You get underreaction, for sure. The price slowly, calmly, and kind of boringly drifts up to its true value as the news spreads. It gets there eventually, no drama. But now, let's add the momentum traders to the mix. They see that initial slow drift, and they pour gasoline on the fire. Their buying makes the price rise faster, which attracts even more momentum buyers, creating that feedback loop we talked about. The price doesn't just reach its true value, it blows right past it in a massive overshoot. And we all know what goes way, way up must eventually come down.
That overreaction is what leads to the inevitable and often painful reversal.
So here it is, the big reveal. You don't need two separate theories for these two market puzzles. You don't need one explanation for momentum and a totally different one for reversals. In this brilliant model, the completely rational attempt by momentum traders to exploit the market's underreaction is precisely what causes the overreaction. The first puzzle literally creates the second one.
Now, this is way more than just a clever theory on a blackboard. The really cool part is that it makes some very specific, very testable predictions about where we should expect to see these patterns pop up in the real world.
So just think about it for a second. If this whole drama kicks off because news travels slowly, what kinds of companies would fit that description? Where is news more likely to travel by word of mouth instead of being blasted across every terminal on the planet in a millisecond?
And this is where the theory gets its predictive power. It suggests that momentum and reversals should be way stronger in smaller companies, the ones where news just takes longer to get around. The same should be true for stocks that aren't followed by a million Wall Street analysts. The slower the news travels, the bigger the potential for this whole cycle to play out. And guess what? When researchers, including the authors themselves, actually tested this, that's precisely what they found in the real-world data. Momentum strategies really are most profitable among smaller stocks with low analyst coverage, just like the theory said they would be. The big takeaway here is actually pretty profound. It tells us that the market isn't just some perfect machine for processing facts and figures. The very structure of the market, the pathways information has to take, and the different types of people it passes through can create these huge predictable swings that look totally irrational, but actually have a surprisingly logical behavioral cause.
And that kind of leaves us with one final fascinating question to chew on. If the simple, isolated actions of just two types of traders can create this whole epic drama of momentum and reversal, what other complex market behaviors are out there, being driven by simple interactions, just hiding in plain sight?